daily time frame, the euro dollar actually made a doji candlestick slightly and found resistance at the moving average 20. We also see that the moving average 20 is moving towards the moving average 50, and today's daily candlestick just went below the moving average 50. So it gives us today some bearish signals, and as you know, as everybody knows, we are waiting for ECB monetary statement tomorrow, and there is some cautious in the trading in the euro. So in terms of euro and dollar trading, we consider the technicals may be put on the sidelines, and then the euro dollar will be mostly driven by the fundamental developments in this couple of days. And if we go to the lower time frame, to the H4 time frame, we see that the currency pair has also dropped below the moving average 20 here, but there is also strong resistance and strong support. So in my view, there should be a cautious trading. In addition to that, investors looking at the European Central Bank statement tomorrow, they say they have speculated, some of them have speculated that we may see a reduction in the deposit facility of the European Central Bank from 0.3% to minus 0.4%, from minus 0.3% to minus 0.4%. But apart from that, the lending and the main rate will remain the same at 0.3 and 0.05% respectively. There has been some, way on the euro because the inflation is expected to drop further in February. The February estimation is at minus 0.2% for the inflation, while in January it has been at 0.3%. So they are setting some selling pressure on euro dollar, and so what we are expecting for this one is that we may see a drop down below the 0.967 today on the intraday, but this is not going to be persistent as I'm expecting, because we have the news, and I'm expecting the euro dollar to move in sideways. So at the euro dollar 30 minutes, if I see a drop below the 1.0966, I may take a short position, which is going to be an intraday short-term position with a tight stop loss and tight take profit as well. So we will see that. I'm going to follow the euro dollar for a short trade. And also the next one that I'm going to discuss about is the USD Canadian. Today we have again another central bank releasing the monetary statement. The rates are expected to remain the same at 0.5%. However, we're going to focus on the monetary statement, where the Stephen Poloz, the governor of Bank of Canada, will talk about the future monetary path he's going to follow. In previous comments, he said that the Canadian economy is doing better than other economies and has sounded less dovish than other times. So I'm expecting to see what he's going to say today, and I believe that the USD Canada will be driven by the monetary statement mainly. In contrary from yesterday, where we saw it driven by the US oil prices. And so in the daily time frame, we see the USD Canadian going down to 1.3259, which is a new low since November 2015. It's a 3-month low, and then it bounced up. That was supported by the rising oil prices, but yesterday we saw the oil prices falling, and actually the Canadian dollar and the other commodity currencies were driven mostly by news from China. China yesterday released data for their trade balance, which was less than expected, and that actually put some pressure on the commodity currencies like the Canadian, and also increased the risk-averse sentiment. So let's go to a lower time frame of the USD Canadian. We can see at the USD Canadian hourly that the currency pair found a support at 134.47. In addition to that, before the resistance at 134.47, this time frame here, it seems like a head and shoulder. So we see a reversal head and shoulder. So we see a shorters at 133.08. We see the head at 132.60, and then the prices bounced up to 134.47. I believe this move is done for now, because we see that the price from 132.61 to 133.68, the rise up move was 100 pips, and then we have another, after penetrating this head and shoulder resistance at 133.68, we saw the currency pair moving almost 800 pips, which is close to this move, and now is falling lower. I believe that if the risk-averse sentiment persists in the market, the USD Canadian could go a bit higher to 134.70. And in addition to that, what I wanted to say is that we see this is the US dollar. It found a support at 96.87 and bounced up. That was mainly because the US dollar worked as a safer currency to commodity currency pairs because of the Chinese disappointing news. Because with the disappointing news, demand left from the high risk currencies and went to the dollar. And with that said, if we see the US dollar increasing, then we're going to see the USD CAD rising as well. However, I'm expecting your Yakub, your analysis on US oil in order to get more clues about this. And also about the Aussie USD, which is the next one that I'm going to look at. So for the Aussie USD, looking at the more long-term picture, the prices penetrated the previous week the 0.7386, which has been the upper limit of the range, and it touched a 7-month high at 0.7483. So in a long-term picture, what I see here is that we may see a reversal of the trend, and we may have a longer-term bullish structure. So, and here also we can see that the next Fibonacci levels extensions at 161.8%, it at 0.7721. So over the long term, we may see prices moving towards the 0.7721. However, on the daily, again, because of China and some disappointing news about the Aussie USD, we saw the Aussie USD falling to support at 0.7411, and the disappointing news from the Australian economy were due to home loans falling by 3.9% in February against expectations of minus 2.7%, and in addition to that, we have a Westpac consumer sentiment being lower than expected. To have in mind, the housing sector in Australia is a very big sector. The housing assets are 3 times more than the GDP of Australia. The value of the houses in Australia is 3 times more than the GDP of Australia. So when we have a negative news on housing sector in Australia, that impacts immediately the Aussie USD. So on the intraday on the H4, we see that it found a support at 0.7411. That could be also a chance to reposition ourselves on the long side, because we see there is an uptrend in the H4, and if we put another trend line here, we see that this touching higher highs, the Aussie USD. And with that said, I think I'm done, Jakub. Let me look at the lower time frame.
That's also in line with our analysis, by the way, from yesterday, where we said Aussie dollar long positions are preferred from 0.70 425, I believe it was level from yesterday. So if you are holding on to that level, you are on the good side. I just have a question for you, because I know that most of the participants here are not really fundamentally knowledgeable. Could you please share your overview about the Chinese news that we have received over the night? What was it that people had to really look for from your perspective?
You mean on Tuesday morning, right?
Yeah.
Yeah, actually the trade balance narrowed, and that triggered some risk-averse sentiment because the imports of China reduced, and when the imports of China reduced, it means that other economies are going to do bad, because commodities and products and goods from other emerging or developed economies, demand for these goods is reducing. You know, China is one of the biggest economies at the moment. They are consuming a lot. They are a growing economy. The people in China are, their income is increasing, so the demand of China is increasing. However, this dropped in the trade balance that happened in February is explained due to the Lunar New Year and celebrations, where the trade was reduced because of these reasons, as a lot of economists say. And so this is going to be some short-lived trade narrow, and we expect that the trade balance of China will recover in March and in next months. So this risk-averse sentiment, actually, that is happening now in the market, I personally expect that it's going to be short-lived. And for that reason, I see the Aussie USD weekly break as a valid one. So I expect the prices to continue on the to higher ground for the Aussie USD, because, as I told you, the risk-averse sentiment that was triggered due to the China negative trade balance is going to be short-lived.
That's also what I believe as well. Okay, let's move on to other commodities. So from my side, I'll just take it over. So let's move on. Yesterday, when we were discussing about the crude oil, we said that it's a great opportunity to sell crude oil from 38.30 level. And we said that initial targets will be $1.8 drop. So basically from 38.30, we were expecting a drop to 36.50 level. Let's see if really it touched it. The lowest low so far was 36.10 level. So the market has really touched the level that we were aiming for, and so far it has found itself a resistance. So 1.8. If you want to put monetary, it's basically 180 pips profit opportunity. Another thing that you should be really looking for on daily time frame, again, if you combine yesterday's and also Monday's candlestick together, what you will see is on today's candlestick together, it will become a sword candle that I have been always talking about. A sword candle is something that that turns the wheel around and brings the bears on board. So the question for today is, what can we really expect from crude oil? The answer can be pretty simple and pretty easy. Unless you see the market break below the 36.06 level, just a little down here, it is not a trade entry yet. And the reason being the fact that as a part of our candlestick trading strategy, we look for sword candles that I just talked about. It's an ironic candle, because the reason why I'm looking for the word sword is the fact that sword is sharp. It cuts off the trend. So whenever we have the sword candle, it cuts off the trend, and the drop that we can see should be just below the lowest low of yesterday. So that's the main reason why we are going to be looking for 36.06 level. If that level is broken below, the immediate target is going to be a very short one. It is 35.70 level, and that's the 100% Fibonacci retracement zone. However, the main target that I'll be looking for will be 34.85 level, which is just somewhere over here. The reason, I need to delete this. The reason being the fact that 34.86 level is 88% Fibonacci retracement zone. I know you don't have the 88% on your chart. This is a custom Fibonacci. And the reason why I'm looking for 88 is because Fibonacci starts with 1. You can also turn it to 90%. It will pretty much become the same. So this is my expectation. Short entries below 36.06 with targets first to 35.70 and second 34.85 level, and that's going to be the daily targets for crude oil. This is the WTI US crude oil. And the next part that you should really look for is that 200-hour simple moving average also falls onto 88% Fibonacci retracement zone. So that gives us an opportunity to believe that indeed there will be a massive support there. You can see that it was a major resistance level between 34.85 level and 34.50 level for the last couple of weeks. Now let's move on to gold. I have to go as usual on weekly time frame. On gold, we can see that the valuable metal is still above the 161.8% Fibonacci retracement zone. However, the momentum on the bullish side is not really strong enough. So it makes me believe that it is not a good idea to long. And last but not least, if you look for yesterday's candle, it's a possible reversal candlestick formation. And if we move on to 1 hour time frame, the next target that I will look for is that if we see a break below the previous hour's lowest low, which is 12.55 level, and any hourly candle close below that level, I will look for further bearish entries. The first target I'll have will be 12.48 level. Basically from here it's $7 drop more or less. And the second target I'll have will be to 12.43 level. This is another $5 drop. And last but not least, I should be aiming to exit my short position at 12.28 level, which is 138.2% Fibonacci retracement zone. The very final pair that I'll look for today is going to be US dollar Japanese yen. Once again on weekly time frame. If we look at the pair, we will see that there is a possible continuation candlestick formation. However, the odds are currently against the bullish market development. Nonetheless, we should be cautious on bullish entries, but on daily time frame, we can clearly see that there is a major support level at 112.12 level, more or less. So if you are shorting, my advice or recommendation for you would be cautious, especially at 112.12 level, and be aware that there is a likelihood where the market could be reversing from that level. The reason for it is another Fibonacci that I can draw over here. If I combine the previous waves, highest high to lowest low, you will see that basically we are looking to 38.2% Fibonacci retracement zone over here, and that's the level that generally reverses backwards. If that level doesn't hold, I have also a pending buy limit order, and my buy limit order is at 111.35 level, and that's the 10% Fibonacci retracement zone. And I'll be looking for overall a bullish development to 114 level for USD Japanese yen. Please.
Yeah, it's the promotion that we have for the participants in the webinar. So for every one participant in the webinar, we're providing a lower spread account, professional account. So you need to register with us, state that you have been participating in the webinar, and we'll get the participant names and emails from Jakub, and we were going to give, for people who are going to request it, open a live account and fund it with minimum $200 deposits, and we're going to give a lower spread starting from 0.9 pips on majors.
All right.
So yeah.
That sounds good. So Adamos, I just want to ask it, for how long this special promotion that you guys are giving with A to Z Forex is valid?
So we don't have a final date for that. So as long as we're doing the webinars, and why not give to the participants lower spread accounts so they can test their strategies, and they can even test what we are suggesting them on the webinar. And yeah, there's no final date for that.
All right. Thank you so much. We have another question over here for me to take a look at GBP USD as well over here. Well, my view is still on bullish side for the fact that we don't have a lower low. If you look at the price action development, except yesterday's on hourly time frame, we have a lower high. So my recommendation or my outlook would be look for a break above the on our hourly time frame, break above the 50-hour moving average, simple moving average, which is 1.4218 level. If it breaks above it, we could be able to look for further bullish targets. And bullish targets should be initially targeted at 1.4330, 1.4340 level, which is 88% Fibonacci retracement zone.
A general question about fundamentals, right?
Correct.
So mostly we look at what impacts the central bank's interest rate decisions, because or monetary policies. So what impacts directly the interest rate decisions of the central bank and monetary policies is the inflation and unemployment. So if we look at the central bank's initial statements and targets, for example, the Federal Reserve is looking to balance between unemployment and inflation. The European Central Bank is looking to is targeting more at inflation, so they don't care so much if the unemployment exceeds some level. So we see that the NFP is very important, but at the same time is not so important the European employment data. And at the same, in Japan, we see that inflation is very important, but the reason for that is that employment is very low, unemployment is very low in Japan, and they have deflation issues. Australia, the Reserve Bank of Australia is looking to balance between inflation and employment, like USA. So the data that we're looking mostly is inflation and employment, and then after that we have some subcategories for economic releases that they affect inflation and employment. It's the consumer sentiment, consumer income. We have the housing sector in Australia. We have factory orders, retail sales in USA. So it's multiple things that impact the dynamic forces in Forex.
If I could also add something on it, although unemployment or employment is very significant part of the fundamental developments, etc., you get to see the investors shifting their attention actually from employment or unemployment figures to the details of the unemployment figures. Like, yes, as an example, one thing we need to look into is the past last week's NFP announcement. Although the number was positive, we saw the US dollar depreciating. Now you might be asking yourself, why did the market really react like that? The NFP figures are positive, so what's the deal? There is a famous word saying that the devil is in the detail. So the devil is in the detail. If you look into the details of the unemployment or employment factors, you would see that the average weekly number of hours put by the average Americans actually dropped. So if you are looking at it from that perspective, the newly created job opportunities were basically simply created by cutting off the existing employment contracts and just sharing the same labor hours with more people. This way, the employers are basically looking for more productivity, because if a person is working less, he is more productive. And on the other side, it also means that employers are not really creating job opportunities, but they are just looking for different kind of economic development, because from state to state, the state is also giving more tax reliefs, etc., for those enterprises creating job opportunities. So this is just the question of which one came first, egg or chicken. So
yeah.
1 plus 1 is 2. It's not 5. So if you are looking at average 40 hours of labor, and average 40 hours of labor should be translated into one person job. But what the US employers are recently doing is, if they have 40 hours, they would basically hire 2 people. They would become, in our view, or investors' view, they become not as 2 employment opportunities, but just 1 employment, but cheating the economy, and the investors are punishing the US dollar for that reason. Okay. I don't know what's your view about this, but this is my personal opinion, because I see that, if you look also at the inflation basket as well, from time to time, there is the central banks or central committees of statistics of the specific countries are actually cheating in order to get their numbers right. So there is also an article on A to Z Forex. If you're participating, you should definitely make sure to read. It's called Real Unemployment Data. Just go ahead and check it out there. With the divergence policy between the Fed and the ECB, how long before they are back in line? Or what's the expectation?
Personally, I don't expect them to get back in line for the next 2 years. First of all, ECB is looking to add stimulus at the moment, and there is speculation for ECB to lower some the deposit facility rate, as we said before. And at the same time, the Federal Reserve may increase the rates again this year. So what I see is that most likely we're going to have further divergence than convergence in this year or the next one.
And do you still believe that it will happen because of the fact that we have the presidential elections and literal global chaos coming up?
I don't know about that, but I don't know about the presidential elections. Okay, presidential elections may impact the economy and so on, but in my mind, what I have is that the Federal Reserve has been doing quantitative easing for so many years now. So they have increased the money in the market and in the money in the world, the US dollar in the world, to unprecedented level. So they have to do something to limit this, because we will see, for example, that if the emerging markets go into a trouble in the following year due to China going down, the US dollar strengthening, because the US dollar will return back to US economy. And you know, they have been giving 80 billion per, they have been buying bonds, they have been buying bonds from market for so many months before. And that money actually went out of the US economy. People were taking the US dollar printed and they were investing into emerging markets, mainly in China, Brazil, Russia. So now that we see that they are in some kind of trouble, as China is getting, the growth is stabilizing, doesn't increase, or the growth is falling, the GDP growth is getting softer in China. What I expect is that the US dollar will return back to the US economy, the US dollar will increase, and at the same time the Federal Reserve will need to reduce the money, the USD money flow in economy. So I expect at least another rate hike until the end of this year. Not much, but this, coming back to the question, is going to further diverge Federal Reserve from ECB.